Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to talk about the U.S. office market. We'll look at how 2013 numbers shaped up. We'll also take a look at a forecast for 2014. We'll also look at some user strategies for this point in the real estate cycle and the economic cycle. Please welcome my first guest, Walter Page, Director of Research for Office for PPR and the CoStar Group. Walter, thanks for joining us in Studio One today.
Thank you.
Well, we appreciate you being here today. And first of all, if you could start us out, how did the office market perform overall in the U.S. in 2013?
So for 2013, the office market performed as we expected, which for an office forecaster is a great thing. Office markets for the first time since 2007 cracked the 3% rent growth metric, 3.1% on a national basis. That's the metric that people often use for Argus modeling. We saw office vacancy rates decline 50 basis points to 11.9%. And we saw about 59 million square feet of net absorption, which was over a 20% increase in net absorption versus 2012. All in all, it was a good year and a very broad base. Only 3 markets across the country had negative net absorption for the year. So it was a very good year for office markets across the country.
Well, that's a nice trend to see. So that's the best year since pre-recession, right?
Yes.
Increases in rates. Wow,
yes.
That's
nice. Everything's starting to right the ship and becoming closer to what I would call the long-term average. Mm-hmm. The long-term average vacancy rate is 11.4%. We're at 11.9. Mm-hmm. As we move towards that long-term average, things are going to feel better for owners of real estate. They'll feel more normal, and I think that's what we're entering in right now.
Okay. What about Class A versus Class B office space? Was there much difference there in performance last year?
So the flight to quality continues, and maybe even more than we expected. Class A space, what we call 4 and 5 star space in our metrics, generated net demand growth at about 1.9%. That was 4 times faster than the Class B space. So a significant source of demand for Class A space. And Class C space, no net demand. In fact, we saw about 20 million square feet of removals across the market. So the demand numbers were very weak. What that means is that if you're an owner of real estate and you have Class B space and you can improve it to Class A space, you're more likely to be able to lease it up. That's really what we're seeing is the demand is very, very strong for the best quality space.
Well, that's interesting because, it looks like a lot of the companies, a lot of the users have been able to move up in quality as well. I know we see some of the tenants that we work with that will go to C to B and B to A. So it's interesting to see that. Well, what about central business district versus suburban markets? What do you see there overall around the country?
So that may be one of the few surprises in the marketplace. Central business districts are generally a place where people want to be and things like that. But you know where the net absorption is? Right. 90% of it is in the suburban markets. Now, to be fair, 73% of the space is in the suburban markets. So you would expect there to be more net absorption in suburban markets than in CBDs. But the question is why? Well, CBDs have some things that are not doing so well in terms of the economy. Think of government, not necessarily doing all that well. The legal sector, we're having space consolidation. And then the suburban markets have things that are doing exceptionally well. For one, technology is mainly located in suburban markets. So San Jose is mainly a suburban market. A lot of places like Austin and Boston and places like that have most of the technology employment in the suburban markets. And then we also see that the suburban markets are, the housing recovery is helping those markets significantly. So a shift. Now, one thing I must say is that increases in rents have been focused to CBD markets, about 3.5 to almost 4% on average, while the suburban markets have trailed that by about a percentage point.
Okay, that's interesting. We're talking with Walter Page with CoStar about the office market. And so, Walter, these are great trends for the office market, better than we've had for several years. What do you expect moving forward into 2014?
So for 2014, we think it will be the best point in this market cycle for occupancy recoveries. This past year, we had a 50 basis point recovery in occupancy rates. We expect to see 60 to 70 basis points of occupancy recovery. With that occupancy recovery, we expect to see significant increases in rent. Now, last year we had 3.1. We're not going to return to the days of rent spikes on a national basis. In 2007, we had over an 8% increase in rents. We're forecasting more in the magnitude of 3.5 to 4% rent growth on a nationwide basis. Now, some markets are going to do better than others. Technology markets continue to do very well. Housing recovery markets are now finally turning the corner, but it's going to be pretty broad base. Markets like Denver, Seattle, even Atlanta are all turning the corner and doing much better than what they were in the past, and are likely to in the future.
Okay. Well, one would expect that the improvement in fundamentals in the office sector would also increase the sales velocity, the investment sales in particular. How did sales volume perform in the office market in 2013?
So we see a sector shift towards office investment and somewhat of a sector shift away from the multifamily sector. Overall, office sales volumes for the year are up in the magnitude of 10 to 20%. Now, and in particular, if you look at the fourth quarter of this past year, office sales volumes are basically even with a year ago. Now, we had a whole bunch of tax law changes at the end of last year, or at the end of 2012 that might have caused some things. But if you look at office compared to all other property types, all the other property types are down about 20%. So we're seeing a shift towards office, and what that's relating to is also an increase in office values. On average, office values are up 5 to 10% from a year ago. So clearly the market is anticipating a good recovery in the office market.
Now, those increased values, Walter, because of the increase in NOIs, or is some of it cap rate and buyer demand? What did you see for cap rates for various types of or classes of office properties in 2013?
So first thing, there is a crush of capital to real estate, and that is very evident. However, that crush of capital was mainly focused to the first half of the year. In the second half of the year, what we did see is that the impact of rising interest rates were a significant factor. And so the net result is that the cap rates over the past 6 months have basically been stable. We've also been seeing that there's been a shift to second-tier markets. So instead of being in New York and San Francisco, investors are more willing to invest in markets like Atlanta and Seattle and Denver and places like that. So those are some of the big picture trends that we see.
And what are some of the other cities that you think of the big five where investors have been focused? You say there's more second tier interest. What are some cities that might surprise people that are seeing more of a sales volume for office sector?
Well, actually, one of the places that have seen a lot of sales volume is Atlanta, is picking up. Places like Tampa, Central Florida. In general, we see a general expansion to a lot of the second-tier markets.
And you said there was 3 cities, I guess, that had negative absorption, and I guess they probably had sales velocity drop as well. What are some of the cities that are having a little bit more of a struggle?
Okay, well, the 3 cities that had negative net absorption: Minneapolis, New Orleans, and Tampa. But the places that actually have the more significant distress happen to be northern New Jersey. And that is because of the drug companies curtailing what they're investing in, or actually they're curtailing their business because the pharmaceutical patents have expired. And so we're seeing millions of square feet being put back on the market by these people, and the vacancy rates are elevated.
Well, sounds like an exciting year for the office sector in 2014. Walter, thanks for joining us today.
Thank you.
If you like more from Walter Page and CoStar, visit CoStar.com. Well, stay tuned. We're going to have more on the office market, including a market participant from a REIT. We'll also have a broker. We'll share some office use strategies for office users in 2014 at this time in the economy and this time in the commercial real estate sector. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.